Canada. We're joined by Jim Thorne, Chief Market Strategist at Wellington-Altus Private Wealth. It's great to see you.
Good to see you too.
The TD thinks that the Bank of Canada might hold off next month from cutting again. Do you think they will?
The credit markets are saying the next two meetings are live, but barely live. So there's about a 60% chance of rate cuts in July and September. So I would suggest that coming into this year that we were going to get 3 rate cuts. And, so let's see how the data plays out. But I would suggest to you that we have turned the corner. And it's funny talking to you because we started talking about this when they started raising rates all the way back 4 years ago. So yeah. I'm of the, we've been non-consensus for all this along the way. And, it's funny watching some of the response from Bay Street. Now they're saying, 2% cuts and so on and so forth. We really think that by the end of 25, interest rates are going to be dramatically lower. And so it's not so much about the cadence. So if you ask me what they should do, the yield curve is inverted, right? So short-term rates are higher than long-term rates. Banking and credit creation is really simple. You borrow short and you lend long. There's no credit creation happening in the private sector. The private sector is hammered, right? We could argue about why Mr. Macklin did what he did. Interest rates are the price of credit. Interest rates are inflationary. If you take out the shelter component of CPI, we are, over 9 months, we're below 1% in terms of inflation. So the real question is when do they cut significantly enough to normalize rates? And when they do, what does the damage to the private sector? And I think the last thing we have to understand is that the economic growth that we've had over the last 1.5 to 2 years is a mirage, and it has been stoked, or a sugar high created by the Trudeau NDP coalition to spend money in a fiscally irresponsible way. When that stops, we will see an air pocket of economic growth in this economy.
So you think that the Trudeau government will be forced to rein in some of this spending?
I think you're starting to see the calls for that. And it's not spending. So even if they just maintain spending at this level, there's no growth. So if you and I spent $1,000 this year and next year we spend $1,000, our spending doesn't go up, growth doesn't go up. So the private sector is buckling. We need help. We're in front of a tidal wave of mortgages that need to be renewed. And it will be very interesting to see how Tiff Macklin and the other Western Central bankers deal with this. But I have to applaud Mr. Macklin for cutting, because he could have easily taken the easy route and not cut whatsoever.
Just say, out of an abundance of caution, or yeah.
Right. Well, and let's be clear, right? Bay Street was not banging pots and pans. Like the banks and the insurance companies were not banging pots and pans saying they have to cut. Every time we would come up to a meeting, they would push it out and push it out. Look, Canada is not the United States. We are highly interest rate sensitive, and the damage that's been done could affect Canada for the next 2 to 3 years.
Yeah, that's interesting. So the banks, you're feeling the banks did not necessarily want Macklin to cut. Isn't it good for their business model?
It is, but when you see their strategists and their economists come on TV or go in the press and they say they're going to keep pushing it out, that's what I'm talking about. The higher for longer narrative that has been propitiated by Bay Street, all of a sudden, you can just watch the tape of what was happening today on BNN. They quickly punted. Now you've got people who are saying, they're taking it to, I was always this, I was always that. Well, at Wellington, we're building portfolios and we're trying to stay ahead of the curve. And so the real question we're asking ourselves, Andy, is what does the Canadian market look like if the Bank of Canada starts cutting rates aggressively? Is it time to get back into the Canadian market? The TSX is underperforming the S&P 500 and the NASDAQ 100 by close to 10% in the first half of the year. what does this look like? If interest rates, and we think interest rates could be significantly lower than 2% in the coming years. Is it time to buy bond proxies? What about Canadian banks? Those are the questions we're having right now.
I mean, are the yield stocks a buy, broadly speaking, on that interest rate basis?
If the Bank of Canada cuts rates aggressively, you could see a relief rally, but you could see the reaction to them today, right? And I think the real problem we have in the bond proxies in this country is, you know, it's a big red flag when companies issue debt or stock to pay a dividend or buy back stock. And in my career, that has just been a do not go. So there are companies that we will determine bond proxies, let's not name them, that are basically have been financing their dividend payments through debt issuance. Is that a sustainable business model? We say no, but could there be a relief rally? Sure, right? But you know, the shareholders will be right for the wrong reasons. So at Wellington, what we're doing is we're having conversations is, do we want to participate in that type of relief rally, you know, on a rental basis for a tactical trade? Those are the questions we're asking. So we are positioned in the United States. We are out of Canada. We're having a very good year in terms of performance, but what we're trying to ask ourselves is, when do we start to leg back into Canada? And we think it's just a little bit too early